Hello, everyone, and welcome. So today, we're going to talk about accounting, but probably from a perspective that's a little different than what you're used to. We're going to move way beyond just debits and credits and really get into how accounting is a critical, powerful tool for making strategic decisions. Now, for you, as future leaders in the business world, getting a handle on this is going to be absolutely invaluable. We're not just here to memorize the rules, we're here to learn how to use them to make smart, effective, and most importantly, ethical decisions that are going to shape the future of whatever organization you end up in.
All right, let's just get one thing straight right from the get-go. I know a lot of you probably came in here thinking accounting is just a math class. And look, yeah, there are numbers involved, but the real heart of accounting, it isn't arithmetic. It's communication. You've got to think of accounting as the language of business. Seriously. And just like any language, it's got its own vocabulary, its own grammar, and we use it to tell the financial story of a company. You know, how it's performing, where it stands. And becoming fluent in this language, that's what gives you power. It lets you really understand a company's health, it lets you convince investors with a story that makes sense, it lets you justify big strategic moves, and it helps you build a culture where people are held accountable. It's a framework for influence. So for today, let's put the calculator aside for a bit and focus on the conversation.
Now, before we dive into any of the technical stuff, we have to talk about the absolute foundation that this whole system is built on, and that's ethics. Because without a rock-solid commitment to ethical principles, all those financial statements, they become meaningless. They lose all their value. They stop being a tool for honest communication and, well, they can become a tool for deception. In business, you'll learn that trust is probably your most valuable asset, and it is incredibly fragile, and it's built and kept through one thing: unwavering ethical conduct.
So let's put a more formal definition on this. The key words here are integrity, fairness, and transparency. Now, integrity, that's more than just being honest. It's about sticking to a strong moral code, especially when you're under pressure to bend the rules. Fairness, that means you're presenting financial information without any spin, no bias that helps out one group, like management, at the expense of another, like investors. And transparency, well, that's just about communicating everything clearly and openly. No hidden agendas, no leaving out important details. And these are not just, nice-to-have ideas. They are the actual pillars holding up the entire global financial system. When they fail, the consequences are, well, they're severe. Just look at what happened with Enron and WorldCom. Those were massive ethical failures, hiding billions in debt, and it led to absolute catastrophe for employees, for investors, and for public trust in general.
Okay, so that definition is fine for a textbook, but it's pretty abstract, right? The real test of your ethics doesn't happen in a lecture hall. It happens out there, when you're under pressure, when maybe your job's on the line, when you've got people pulling you in different directions. So let's try to make this feel a little more real.
Let's break this down, because this is a classic dilemma, and it's a lot more complicated than it looks. This is a sneaky kind of manipulation we call earnings management. And trust me, the pressure to hit those quarterly numbers is intense. The core accounting rule you're breaking here is called the matching principle. It's a cornerstone of how we do accounting, and it basically says that you have to record expenses in the same period as the revenue they helped create. So pushing an expense into the next quarter, that breaks the rule. It makes this quarter's profit look better than it is, and it makes next quarter's look worse. You're distorting the truth in both periods, and what you do here, it really does define your professional character. Are you going to stand up for your own integrity and the accuracy of the reports, or are you going to cave to the pressure? This is where that abstract idea of ethics gets very, very real.
Okay, so if ethics is the foundation of trust, then accounting standards are the rules of grammar for this language we're talking about. They give us the structure that lets us communicate financial information in a way that's consistent and clear, whether we're looking at one company or another, or even companies in different countries. Without these rules, it would just be chaos. Everybody would be telling their own financial story in their own way, and comparing them would be totally impossible.
So let's look at the two big players that set these rules for the whole world. Here in the United States, we have the Financial Accounting Standards Board, or FASB. They set the rules we call U.S. Generally Accepted Accounting Principles, or GAAP. Every publicly traded company in the U.S. has to follow these. Now, for most of the rest of the world, companies use International Financial Reporting Standards, IFRS, and those are set by the International Accounting Standards Board, or IASB. Now, both of them have the same basic goal: make things consistent and comparable, but there are some really important differences between them. And because our economy is so globalized, there's been this huge push for years to try and merge these two sets of standards into one single, high-quality, global standard. It would just make everything so much simpler. This is a great way to think about the difference between US GAAP and IFRS. People often say US GAAP is rules-based. It gives you super specific, very detailed instructions for almost every situation you can think of. IFRS, on the other hand, is known as principles-based. It provides a broader framework, which means it requires a lot more professional judgment to apply it correctly. Let me give you a quick example. Under IFRS, a company can revalue its buildings or equipment up to their current fair market value. So if your headquarters is suddenly in a hot real estate market, you can actually increase its value on your books. US GAAP? Nope, generally prohibits that. The building stays on the books at which you originally paid for it, minus depreciation. One isn't necessarily better than the other, but as a leader, you have to know which set of rules you're playing by, because they completely change the story you're allowed to tell.
All right, let's build on that and move to our next big idea. So we've got our ethical foundation, we've got our rules of grammar, but now we have to figure out how to actually measure things. How do we assign a dollar value to everything a business owns and owes? And believe me, it's not as simple as it sounds. There are really two competing ideas at play here. The first way, and the most traditional, is called historical cost. The whole idea here is about being reliable and verifiable. So if a company bought a building for $1 million back in 1985, that building is on the books for $1 million. That number is objective. It's backed up by a real transaction, a real receipt. It stops companies from just making up asset values. Now, of course, that building's value gets reduced over time through depreciation to show it's being used up. But the starting point is always that original historical price. The other way of thinking is called fair value. You might also hear it called mark to market. This approach cares more about relevance than reliability. The argument is that what a company paid for an asset 30 years ago is, well, it's a lot less useful to someone making a decision today than what that asset is actually worth right now. Now, for some things, like stocks, finding the fair value is easy. You just look up the price. But for other things, like a custom-built factory or a unique patent, figuring out the fair value is really complex and, honestly, pretty subjective. It often takes hiring experts and using sophisticated models.
Okay, so this is the crucial point. This slide gets right to the fundamental tension in accounting valuation. It's this constant trade-off between objectivity and relevance. Historical cost? Super objective, but it can become less and less relevant as time goes on. Fair value? Incredibly relevant for today's decisions, but it can be less objective and maybe, just maybe, easier to manipulate. And so the accounting standards, both GAAP and IFRS, are basically a giant compromise between these two ideas. For instance, some things like trading securities have to be reported at fair value, but other things, like property and equipment, usually stick with historical cost. As someone reading a financial statement, you've got to be savvy enough to see which method is being used and understand the huge impact it has on the numbers.
This example just makes it crystal clear, doesn't it? Look at the company's balance sheet. If it's prepared using strict historical cost, that headquarters is listed as a $1 million asset. But if you look at the real estate market today, it's actually worth $25 million. That's a $24 million difference in value that is completely invisible to anyone just looking at the primary financial statements. And think about what that means for the company's real net worth, or its ability to get a loan using the building as collateral, or how another company might value them in an acquisition. It's a massive difference.
So let's put on a different hat for a second. Let's say you're a loan officer at a bank. This company comes to you asking for a $10 million loan, and they're putting up this building as collateral. Now, if you only look at the historical cost on the balance sheet, $1 million, you'd laugh them out of your office. The collateral doesn't even come close to covering the loan. But then you see the fair value appraisal for $25 million. Suddenly, this loan looks a lot less risky, right? As a banker, what you care about is what you can sell that collateral for if they stop paying. You care about the liquidation value. So, of course, you would demand to see the fair value. And this little scenario shows you exactly why both of these methods exist and why you have to understand the difference to make good business decisions.
All right, so we've talked about the bedrock of ethics, the grammar of standards, and these two different ways of thinking about value. The big question now is, how do we pull all of this together into a process, something you can actually use in your career? How do you go from all this theory to making a clear, solid recommendation?
This framework gives you a step-by-step way to think. So, step 1, you've got to clearly define the problem. What's the decision we need to make? Let's say it's how to account for a new, tricky software subscription model. Step 2, you go to the rulebook. What do the standards, GAAP or IFRS, say about recognizing revenue in a case like this? Step 3, you apply the right valuation principles. And in this case, it's more about the timing of the revenue than the dollar amount. Now, step 4 is the most important one. This is your gut check, your ethics filter. Is our interpretation of the rules transparent? Is it fair to everyone involved? Or are we just trying to pull revenue into this quarter to make the numbers look good? Only after your decision passes that ethical test do you move to step 5. You make your recommendation and you're ready to defend it. Following a process like this will help you navigate those really complex, gray area situations with a lot more clarity and confidence.
I want to leave you with this thought because it perfectly sums up everything we've been talking about. Business is a competitive game. It's all about allocating resources. The financial statements, that's the scoreboard. And the accounting standards, those are the rules of the game. If you can't read the scoreboard or you don't understand the rules, you are at a huge disadvantage. Being fluent here, it's not optional for a leader.
So if there's one thing you take away from our time together today, let it be this. Ethics, standards, valuation, these aren't just random concepts you need to memorize for the final exam. They are the actual, practical tools you are going to use to build trust, to communicate what matters, and to create real, sustainable value in your career, no matter what you end up doing. This is your leadership tool.
And I'll end with this one last question for you to think about. The rules of accounting, as detailed as they are, they won't always give you a simple, black and white answer. There are going to be times when you have to use your judgment, when you're operating in a gray area. And in those moments, when it's your call to make, the most important question you can ask yourself is this one. Who does my decision serve? Does it serve a short-term target, a pushy boss, or does it serve the long-term health of the company, the trust of the market, and your own professional integrity? Your answer to that question, well, that's what's going to define your career.